Imagine the economy as a giant train. The Federal Reserve, or Fed for short, is the conductor. Their job is to keep the train running smoothly, not too fast and not too slow. Interest rates are like the train's speed control. When rates are high, the economy slows down. When rates are low, the economy speeds up. An interest rate cycle refers to the ups and downs of interest rate adjustments made by the Fed. These cycles can last for months or even years. The Fed raises rates to combat inflation, which is like the train overheating. Conversely, they lower rates to stimulate growth if the economy is sluggish, like the train slowing to a crawl. These cycles matter because they directly impact how much we pay for loans, from mortgages to car loans. When the Fed raises rates, borrowing money becomes more expensive. When they cut rates, it becomes cheaper to borrow. Understanding these cycles can help you make smarter financial decisions. The Federal Reserve, often called the Fed, is America's central bank. Think of it as the banker for the country's banks. One of its primary responsibilities is to maintain a healthy economy, and it does this primarily by manipulating interest rates. The Fed doesn't set interest rates for your car loan or mortgage directly. Instead, it sets a target range for the federal funds rate, which is the interest rate that banks charge each other for overnight loans. This seemingly small rate has a ripple effect throughout the entire economy, influencing the rates you see at your local bank. The goal is to find a sweet spot for interest rates. Rates that are too low can lead to inflation, where prices rise too quickly. Rates that are too high can stifle economic growth, leading to job losses and stagnation. The Fed's job is a delicate balancing act. The Fed doesn't just wake up one morning and decide to change interest rates. These decisions are made very carefully by a group called the Federal Open Market Committee, or FOMC. This committee meets 8 times a year to discuss the economy and decide on monetary policy, which includes setting interest rates. These meetings are major events in the financial world. Investors hang on every word from the Fed chair, looking for clues about the future direction of interest rates. A slight change in tone from the Fed can send shockwaves through the stock market. For example, in June 2024, the FOMC chose to keep interest rates unchanged. However, they also hinted that 2 more rate hikes might be coming later in the year. This news caused some volatility in the markets as investors adjusted their expectations. Section 4. Interest rate cuts and investment types. When the Fed cuts interest rates, it's like giving the economy a shot of espresso. This can be good news for some investments, while others might not fare as well. Let's start with bonds. When rates fall, existing bonds' value rises. Investors pay more for higher interest bonds. Stocks in growth industries often react favorably to rate cuts. Lower rates mean cheaper borrowing for expansion. Real estate is sensitive to interest rate moves. Lower rates make mortgages affordable, boosting demand. Investing during declining rates. Position your portfolio for declining interest rates. Growth stocks in tech and consumer sectors often shine. These companies benefit from lower borrowing costs and increased spending. Real estate can be attractive with lower mortgage rates. Consider your risk tolerance and investment timeline. There's no one-size-fits-all approach to investing. Section 6. Seeking expert advice. Navigating the world of interest rates and investments can be complex. While it's essential to educate yourself, seeking guidance from a qualified financial advisor is never a bad idea. A good advisor can help you create a personalized investment plan that aligns with your financial goals, risk tolerance, and time horizon. They can also help you navigate the ups and downs of the market and make adjustments to your portfolio as needed, especially during times of economic uncertainty or shifting interest rates. Remember, knowledge is power when it comes to managing your money. By understanding how interest rate cycles work and seeking expert advice, you can make more informed decisions and put yourself in a better position to achieve your financial goals.